Hello, this is Professor Randy Menton, and today I'd like to go over problem 3-1A in your textbook. And this is one of the adjusting entry problems, and most of the adjusting entry problems that you'll see are quite similar to this one. We will do some more, but hopefully you'll start to get a feel for these entries as we go. Now, I went ahead, or gone ahead, I should say, and created for you a journal, that simplified journal, if you will. And on my journal here, I have a date, I have an account, a PR column, which stands for posting reference. We won't be posting the journal to the ledger in this case, but I put it out here just so that you can see what it's supposed to look like. A debit and a credit column. And because these are all adjusting entries occurring on 5/31/2015, there's no sense for us to repeat the date over and over again. We'll just continue to go down the list of accounts that are affected until we finish out the adjusting entries. So let me read the problem. It says, on March the 31st of 2016, the following data were accumulated to assist the accountant in preparing the adjusting entries for Potomac Realty. And it has a series here of, looks like 5 adjustments that we are to make. And so we need to go ahead and get started with these adjustments. It says A, the supplies account balance on March the 31st is $5,620. The supplies on hand at March 31st is $1,290. Now, the supplies on hand at the beginning of the month was $5,620. That's the balance in the asset account. That means that it's a normal debit balance account, and it's an asset and should be. So we now have to go from $5,620 to $1,290. So in order for us to do that, we need an entry that will credit supplies. Now why? Because again, supplies is an asset. That means it has a normal debit balance, and the normal side is the increase side always. So in this case, $5,620 needs to be reduced. So we wouldn't charge anything to the debit side because that would only increase the account, and we need to decrease the account in the amount of the difference between the $1,290 that it needs to be and the $5,620 that it's currently showing. And so the question is, well, where does the other side of the entry go? If that's the credit side, we need a debit side. And what we're going to do is we're going to move the asset cost over to an expense representing the resource being used up. And that expense is going to be called supplies expense. And the credit side, of course, will be the asset supplies. And the amount is going to be the difference between the $5,620 and the $1,290. So I'm just going to let the machine do the work. $5,620 minus $1,290, or $4,330. And because I tend to be a little bit lazy, I'd probably just put an entry in here, a formula in here to make that number bounce over to this side, and I'd probably just say that it's equal to this, because it'd be easy for me to do that, and then I don't have to worry about mistyping it or anything like that. So now we have the first entry being made, and again we're showing the prepaid asset supplies being decreased through a credit in the amount of $4,330. The second entry, B, the unearned rent account balance on March 31st is $5,000, representing the receipt of an advance payment on March the 1st for 4 months rent from tenants. Okay, so on March the 1st, we got $5,000 in cash. We would have at that point debited cash for $5,000 and credited what? Well, we would have credited unearned rent, which is a liability. Liabilities have normal credit balances, meaning they go up on the right-hand side. So in this case, what we have is what we have with our adjusting entry is a reduction of our liability because we've now earned some of that rent. Well, it was originally put in as a credit to unearned rent. We need to put it in now as a debit because we need to reduce the unearned rent and actually transfer that money over to revenue because we're at the end of the month and we've actually earned the money now. So, in this case, unearned rent, the liability is being reduced. And how do we reduce the liability? By debiting it, because the normal balance, the increase side, is the credit side. And if I did my math correctly, 5,000 divided by 4 is 1,250. And on the credit side now, I need to recognize the actual revenue because I've now earned it. So rent revenue. And again, this is going to be the same number. It's always going to be the same number if we have just a single account being affected on both sides, as we do in this case. So that takes care of the second one. And what you would see, by the way, is in the unearned rent account, in the month of May, we started out with a balance in the credit side of $5,000. So now we're debiting at the end of May $1,250. At the end of June, we'll debit again for $1,250, and so forth and so on until we get 4 months in, when the balance in the unearned rent account will become zero, because we will have then earned all of the rent. I'm guessing that's around August, at the end of August. Okay, wages accrued but not paid on March the 31st are $2,290. Well, that means that our employees have worked, but they will not be paid for their work until some point in the future. And a lot of times your wages, or the end of the month, I should say, may fall on a Wednesday. So you're not going to pay until Friday, say for instance. So we're not going to, just because it's the end of the month, we're not going to all of a sudden stop and pay everybody on Wednesday. We're simply going to accrue for the amount that we owe these employees as of that time frame. So in this case, we're going to have wages expense. Why? Because we're incurring an expense. Now typically at the end of the week, what we would have is we'd have wages expense and a credit to cash because we're going to pay some money out. Okay. Now in this particular case, we're at the middle of the week or some other point in time, so we have to actually recognize a liability instead of the cash. Okay, so in this case it was what, $22.90 and $22.90 on the other side. And what was the other side? Well, the credit is going to be wages payable. Now, what will happen at the end of the week or at the end of the pay period when you're actually paying it? Instead of debiting wages expense and crediting cash, you've already recognized the expense. So what you're going to do now is eliminate the liability because you're paying it off. So you debit wages payable and you would credit cash to get rid of it. Okay. Fees accrued but unbilled at March 31st are $16,825. So what that means is that we've done some services for people, but we haven't got around to billing them yet as of the end of the month. However, we know that as of the end of the month, we have a receivable from those people that we've done the services for in the amount of $16,825. So we have to now recognize that we have earned the money and that it is receivable to us at some time in the future, because we don't have it yet. Okay? And the way that we recognize that is accounts receivable. Now, notice that this is kind of incomplete as you think your way through it here. If you do a little bit of critical thinking, I have several probably accounts, several customers that make up that accounts receivable. So I would enter this into some sort of a subsidiary ledger that would have a receivable account for each one of my clients. Otherwise, I wouldn't know who the $16,825 represented. Accounts receivable is an asset, goes up on the left-hand side, $16,825. And we have some revenue that we've in fact earned. This is not unearned revenue. We've earned the revenue. We just haven't collected or billed for it yet. So, whatever our revenue stream is here, rent revenue, I guess, $16,825 is that amount. So now we've recognized the fact that we've earned the rent and will receive it at some future point in time. Lastly, in this group we have depreciation of office equipment of $4,600. So, depreciation of office equipment, that means that the asset itself is losing some of its value going forward. It's being exhausted, that value is. And what we want to do is we want to transfer the value from the asset account to the depreciation expense account. Now, this one is different than most other assets. We do not directly affect the asset balance itself. So in other words, if the asset balance was $100,000 and we depreciated $5,000, the asset balance would still be $5,000. What we're going to do instead is we're going to utilize an account called accumulated depreciation. And the reason we're going to use accumulated depreciation is because we want to make sure that we separate the depreciation side from the asset side, and that becomes important when we start to dispose of equipment through a sale or just a simple disposal. So this contra asset, accumulated depreciation, takes the place of the asset for purposes of depreciation. So depreciation expense for $4,600. Oops, I'm in the posting reference column. Let me get out of there. And $4,600 in the accumulated depreciation what is it? Equipment, office equipment. Okay, that actually takes care of all 5 of those entries, and you know, each one of these would be posted to the ledger account, and we would change those balances in supplies, expense and supplies and so forth by the amount in the debit and credit columns. Journalize, and of course our instructions were journalize the adjusting entries, but we had a second instruction as well. Briefly explain the difference between adjusting entries and entries that would be made to correct errors. Well, when we make these kinds of adjusting entries, these are not corrections of errors. There are timing differences that occur in business. And you know, as you get further along in accounting, you'll find that some of these are tax related, and some of these are related to other things. But in the case of adjusting entries, these are normal entries that we would make at the end of every month, simply to bring the accounting records into their proper state. A correction of error, in other words, there are no errors here. A correction of error is simply that, it's a correction of error. Okay, that concludes the problem 3-1, and we'll go on to another one here momentarily.